Understanding and Working with High-Risk Investors by Guideway Financial, LLC. This presentation was given to the Austin Financial Planners Association in January of 2016. This is not financial advice, nor is it a solicitation of any product or services. It is for informational purposes only. Has a client or prospect ever said to you, "I want to beat the market. I want to maximize returns. How have you performed against the S&P 500?" Or, "I'd like to trade options." The problems with this approach is that it may not fully consider the risk tolerance of the client. The client may not be able to tolerate a significant shortfall, and it may put the client's basic retirement needs in jeopardy. Also, it places a large responsibility of beating the market on the advisor, which the advisor may or may not wish to shoulder. The goal-driven strategy presented here provides a simple risk measurement that's easy for clients to articulate without complex questionnaires. It ensures the client's essential needs are safe. It optimizes the high-risk investment strategy if one is implemented, and it helps soften the blow of potential shortfalls. Moreover, it reduces the relationship impacts when shortfalls occur so that the client will be satisfied with the advisor during investment turmoil. While we haven't performed any studies of client behavior, here are some reasons we believe clients may wish to invest with high risk. They may believe they have insufficient funds to meet their needs, or they may be highly confident. This might include people that have been highly successful in creating new businesses and have had success against long odds. Their sample of one in which they beat the odds may give them a perspective that discounts risk. Or they believe that achieving high returns is easily done without much risk. They may be affluent. This is a class of investors for which high-risk investments may be suitable. Or they may be desperate. Ironically, this is also a class of investors for which high-risk investments may be suitable. An example will be provided later. However, this should be exceptionally rare. Where did this information come from? The research here came out of our study of portfolio optimizations. We found that the optimal portfolio for high-risk investments had very interesting characteristics, and these quantitative insights might provide insights into the behavior of high-risk investing. What is risk? In order to understand the risk measurement we use, let's look at a scenario. John and Judy are 40 and they receive $500,000 in inheritance. They want $1 million by the time they reach age 65. What are the traditional ways of measuring their risk tolerance? Almost all advisors use some type of questionnaire to evaluate risk tolerance, but the end result is often a guess as to a suitable standard deviation. There are many other forms of useful risk measurement, such as the probability of losing money in 1 year, beta, value at risk, and so on. While these can be useful measurements, few of these traditional methods directly relate to the investor's goals. Returning to John and Judy, they simply want to know what the probability is that they will achieve their goal, and they want to know the probability that they will fall short. They want to know the risk of shortfall. The risk of shortfall has several advantages. First, it's goal-driven, and it's intuitive for the investor, and it doesn't need a complex questionnaire to determine. The risk tolerance doesn't change with age. A young person wants low risk of shortfall during retirement as much as the older person. Now, the optimal portfolio will change with age, but not the risk tolerance. The following are required to calculate risk tolerance: a specific date, a specific portfolio, and a specific dollar goal. Another advantage of goal-driven risk tolerance is that the investors can have many risk tolerances, depending on their goals. They may have a low-risk goal, such as retirement at age 95, or they may have a moderate risk goal, such as purchasing a new car in a few years. Or they may have a high-risk goal, such as winning the lottery. The takeaway is that the investors should not be categorized as simply aggressive or conservative. That's too simplistic. Instead, their goals should be categorized. Individuals can have multiple goals with multiple risk tolerances. Next, we will utilize the risk of shortfall to describe two broad categories of goals: standard risk goals with a risk of shortfall below 50%, and high risk goals with a risk of shortfall above 50%. First, let's examine standard goals. Standard goals have a risk of shortfall less than 50%, and they are for critical needs such as food, clothing, and shelter. They're also for important discretionary desires such as eating out or purchasing new cars. The optimal investment for standard goals have the following characteristics. First, they have longer investment histories. Imagine two funds. One has 50 years of data and one has 3 years of data. They're invested differently, yet the newer fund has exactly the same standard deviation and mean return over its 3-year history as the older fund has over its 50-year history. The optimal choice is the older fund, since there's less uncertainty over its statistical behavior. The optimal investment will have less volatility, all other things being equal, and diversification can help reduce volatility. It will also have higher returns, and volatile assets can be used for long-term investments, while stable assets are preferable for shorter-term investments. The goal will be to achieve below average returns, and this will be explained in the next slide. Also, the goal will be for below market returns. The goal of below average returns can be easily explained with an example. Assume an investor will be using an S&P 500 fund for their retirement. The median historical return for the S&P 500 is 11%, but there is a 50% risk that future returns will be below 11%. Few investors want a plan that will fail 50% of the time. Remember, this is a standard goal with a risk of shortfall below 50%. So instead, the plan will target a lower return, such as, say, 7%. The plan will be created so that the goals will just be achieved if the investment returns are 7%. Therefore, the goal will be to achieve below average returns or better, ensuring that the risk is less than 50%. The goal of below market returns is similar and can also be explained with an example. Steve and Susie have a child leaving immediately for college. The 4 years will cost $60,000 and they have exactly $60,000 saved. They could invest in an S&P 500 fund to achieve market returns, but they could easily lose a year or more of funding. Instead, Steve and Susie choose a stable investment, such as a money market fund or CDs. The average return for this investment is far below the average return for the market, but the risk of falling short of having enough money for college will be far lower. Steve and Susie prefer an investment with below market returns. This is why bonds are an integral part of a properly allocated portfolio, even though they typically produce lower returns. Now let's discuss high-risk goals. There are stark differences when comparing standard goals with high-risk goals. The first, of course, is that standard goals have a risk of shortfall below 50%, whereas high-risk goals have a risk above 50%. Standard risk goals are for critical or very important goals, whereas high-risk goals are for more aspirational goals. Critical needs should not be placed at high risk. The standard goal will be to achieve below average returns and below market returns, but the high-risk goal will be to achieve above average and above market returns. The ideal investments will have higher volatility instead of lower volatility, and we'll explain that shortly. Therefore, diversification is not as beneficial. Bill Gates did not become rich with a diversified portfolio of hundreds of stocks. Less historical data is preferred, and shorter-term investments are more volatile, while longer-term investments are less volatile. The only similarity between standard and high-risk goals is the preference for higher mean returns. Let's discuss an extreme form of legitimate high-risk investing, the hobo and the lottery. A hobo wants $1 million in a year. He has $2 left over every week, and he has a choice of 2 investments, an insured savings account at a bank and buying 52 lottery tickets throughout the year. Which of these 2 investments are more likely to achieve the hobo's goals? Which of these is more likely to fall short of achieving his goal? There is effectively a 100% probability that a savings account will not produce $1 million from a $104 investment. At the end of the year, he will have about $104. But the lottery probability of shortfall is far better, about 1 minus 1 in 6 million. It's still low, but his risk of falling short of his $1 million goal is far lower with the lottery. Contrary to popular opinion, the lottery and gambling are not taxes on the stupid or mathematically challenged. The hobo is being extremely rational. He has a specific goal, albeit a very audacious goal. He has a specific time frame, and there are few consequences of failure. It's not a critical need. And he's minimizing his risk. The lottery is his safest investment. So the next time you're in line behind a person buying a lottery ticket, have a little respect. They may be intuitively smarter about their goals than many Wall Street wizards. High volatility is also beneficial for high-risk goals. Here we have two investments with exactly the same mean return, but one has no volatility and the other has substantial volatility. The x-axis covers 80 years, but imagine a 10-year goal of achieving above-average returns. The risk of shortfall is 100% with a no volatility investment. The risk goes far less with the volatile asset. The higher the goal is above the mean return, the more valuable the volatility is. If the goal is below average, volatility is harmful. Less historical data is also preferred for the high-risk investments. The reason is that less data increases the error and uncertainty in the mean and standard deviation. This increases the potential that future returns may be significantly higher than one would estimate from the historical mean and standard deviation. For example, imagine two very different styles of funds. Both have identical measures of mean and standard deviation. The goal is to achieve 3 standard deviations above the mean. One fund has 50 years of data, and so its mean and standard deviation are reasonably accurate. It's very unlikely it will achieve 3 standard deviations above the mean. The other fund has only been around for 3 years, so its mean and standard deviation are probably quite inaccurate. Achieving 3 standard deviations above the mean might turn out to be easy because the measurements are so wrong. Therefore, the low data investment is better. The other odd characteristic of high-risk investing is that shorter-term investments are better if they are held in more volatile assets, and longer-term investments should be in more stable, less volatile assets. The reason is that time dampens volatility. Large gains and losses average themselves out over time, so that volatility of long-term returns is significantly smaller than it is for short-term returns. Therefore, volatility is less useful for long-term investments. For example, one might be able to achieve 400% return in 1 year, but achieving an average of 400% per year for decades would be practically impossible. What we've learned is that we can create 2 broad categories of goals, depending on their importance. The standard goals have a risk of shortfall below 50%, and high-risk goals have a risk above 50%. Also, we now know that the ideal investments for high-risk goals have the opposite characteristics of those for standard goals. The next step is to focus the client on the appropriate goals. If necessary, we may need to talk them out of their high-risk strategy, although high-risk goals are appropriate for some investors. Some investors should not be investing in high-risk investments, and it may be to their benefit to persuade them to reduce their risk. But how can this be done? First, it's not going to be easy for many investors. Some investors have a fundamental belief that high returns can be achieved with low risk. However, the conversation should be focused on goals, goals, and goals. In fact, we're thinking about doing a video and calling it Goals Gone Wild. Ask about how much money do you want? When do you want it? What probability do you want to achieve it? Is the investment going to pay for food, clothing, and shelter? If so, how large of a loss will put food, clothing, and shelter in jeopardy? What's the probability of such a loss? Is your portfolio too small to meet your retirement needs? Do you have a spouse that will depend on this portfolio? What does the spouse think of this investment strategy? If the investor is willing to consider alternatives, suggest a multi-layer goal-driven plan. A 4-layer goal-driven plan has several advantages. It puts the focus on goals and risk. It helps both the client and the advisor determine exactly how much to put in high-risk investing, if any. It optimizes both the standard and the high-risk goals to minimize the risk and maximize the goals. It ensures the investor does not put critical needs in jeopardy, and it potentially shares the responsibility of managing high-risk investments with the client. The safety of the critical needs and the sharing of the responsibility can help reduce any ramifications to the client-advisor relationship if the high-risk investments perform poorly. In such cases, the client's stress level will be significantly reduced because the critical needs are not in jeopardy, and they have a portion of the responsibility as well. The first layer of the plan is the foundation layer. The foundation layer is not really an investment layer. The foundation layer includes expenses that are less than 12 months out, but really the focus is on the basics of financial health, such as emergency reserves, cash flow, debt, insurance, and so on. The next layer is the essentials layer. These goals include critical retirement needs, such as food, clothing, shelter, and so on. Any shortfall on these goals will have potentially dire consequences. The ideal investment for this layer includes index funds because of their long historical track records and low fees. The risk should be below about 15%, although there's no hard rule. In some cases, modest wealth clients may not be able to completely fund this layer. While adjusting risk tolerance can increase or decrease the planned income, other steps should be taken first, including delaying retirement, increasing savings, reducing expenses. The last resort should be increasing risk. The essentials layer should be invested with the lowest risk possible. In order to optimize the essential layer, the portfolio is divided into portfolions. Like electrons, protons, and neutrons, which are the building blocks of atoms, portfolions are the elemental building blocks for complex portfolios. Each portfolio is invested independently from all the others, yet they are all held in the same account. They are tracked and managed virtually. One portfolio is dedicated to fund each year or quarter in retirement, so that the portfolio will be invested for an exact period of time. When a year in retirement arrives, the designated portfolio is liquidated and used as income. Remember, it was said that in order to measure risk, the time of the investment must be known. This method ensures that the time each dollar is invested is exactly known. The asset allocation for each portfolio is optimized for the amount of time it is invested to maximize the target income for the investor's risk tolerance. Here we see the portfolio on the left will be used in the first year. Since it is a short-term investment, the optimal asset allocation is mostly cash and bonds. The portfolios that are invested for longer periods will be more heavily weighted towards stocks, as shown on the right. Yet the risk of shortfall is constant for all the portfolios. The allocation is also based on the investor's risk tolerance. If the investor desires a low risk of shortfall, all of the portfolios will be more heavily weighted toward bonds and cash. If the investor desires a high risk level, all of the allocations will be more heavily weighted towards stocks. This can be used as a last option for the moderate wealth investor who has insufficient funds to meet their needs. The income will vary from year to year, but the median income is higher than that of other methods, such as the 4% rule. It's important that clients understand that results vary and there's no guarantees of income level. However, the income will last exactly as long as planned. If a retiree wants 40 years of income, then 40 portfolios are created. If a retiree wants 60 years of income, then 60 portfolios are created, and the income will last exactly 60 years, not a day shorter and not a day longer. Also, the plan produces the optimal asset allocation glide path to ensure that the asset allocation changes over time to maximize the probable income for the client. In most market conditions, the portfolios will grow to the red line. The risk of shortfall selected by the investor's risk tolerance is the probability the income will fall below the red line in any one year. For example, if the selected risk tolerance is 5%, there's a 5% chance that the income will fall below the red line and a 95% chance it will be above the red line. This line can be used for planning and budgeting purposes. In typical market conditions, the portfolios will reach or exceed the green lines. This level should never be used for budgeting purposes because there's a 50% chance that the income will be below this level. However, it does provide a reasonable upside potential for the client. The next layer in the 4-layer plan is the discretionary layer. This layer is optional, and only after the essential layer is fully funded should money be placed in this layer. It is for such things as travel, entertainment, new automobiles, or any discretionary expenditure that can be easily reduced in the case of shortfall. It should not be for loan payments, because poor market conditions might cause a car to be repossessed or a house to be foreclosed on. The risk of shortfall should be between 15% and 50%. The ideal investment for this layer are index funds, like the essential layer. This higher risk layer will produce more planned income per dollar compared to the essential layer, So this can help the client stretch their dollars further. Let's go through an example of Roger and Rhonda, age 65. They have $1 million in investment assets, and they want 40 years of inflation-adjusted income. Their Social Security income will be $30,000, and their essential expenses are $50,000. They want a 95% chance that their essential needs will be achieved and a 5% risk that their income will fall short of their essential needs. A very conservative plan is created with a 5% risk of shortfall. Their projected income for their investment is $30,000. There is a 5% chance that their income will fall below $30,000 in any one year, and a 95% probability the income will be above $30,000. Combined with the $30,000 in Social Security, their total income is projected to be $60,000 per year. Their essential expenses are $50,000, so that leaves $10,000 for discretionary income. Let's compare that with a plan with both an essential layer and a discretionary layer. In this plan, 2/3 of the money is placed in the essential layer, and it is projected to produce $20,000. The remaining $333,000 is placed in the discretionary layer. However, the risk is adjusted to be significantly higher here. In this case, it's 40%. The income from the discretionary layer is $23,000. That's more than the essential layer with half the money invested. Of course, there's a 40% probability that the income will fall short of the $23,000. When the two are combined, the amount drawn down from the investment is projected to be $43,000, a 43% increase from the essential-only plan. With Social Security, the total projected income is $73,000. After the $50,000 in essential expenses, the discretionary income is again $23,000. That's a 133% increase in discretionary income. To implement the essential and discretionary plan, two sets of portfolios are created. The discretionary layer is higher risk, and so the allocations are more heavily weighted towards stocks. The essential layer is lower risk, and so the allocations are more heavily weighted towards bonds. Also, note that the portfolios on the right are smaller for the discretionary layer compared to the essential layer. That's because the discretionary layer is more aggressively invested and the projected compound returns are larger. Less money is required to achieve the goals because of this projected growth. The final layer is the venture layer. This is an optional layer, and other than the lottery ticket or the occasional trip to the casino, it is probably pretty rare for those who are not affluent. Here the risk of shortfall is above 50%, but it doesn't necessarily have to be precisely quantified. In fact, it may not be possible to precisely quantify the risk. There's also no need for broad diversification in this layer. And these investments should not include index funds, ETFs, stocks or bonds, or any other traditional investment vehicle. The reason is that standard goals seek assets that are lower in standard deviation and higher in mean return. They are looking for assets on the efficient frontier as far toward the upper left as possible. Higher risk goals, on the other hand, need investments that are higher in standard deviation and mean return. They are looking for investments towards the upper right corner. However, if one were to plot their traditional investments, such as mutual funds, ETFs, stocks, and bonds, they will be lumped toward the upper left. There are a few assets to choose from that are on the high risk frontier. Therefore, the venture layer should not include standard investments. Instead, the investor should seek investments with little history, such as startups, seed funding, private equity, entrepreneurial ventures, and so on. These investments should have a short exit window of, say, 5 to 10 years. If possible, these investments should leverage the client's expertise. If the client has run restaurants in the past, then perhaps she can reduce the risk and increase the returns of an investment in a new restaurant. To summarize, the 4-layer goal-driven plan puts the focus on goals and risk. It helps both the client and the advisor determine the proper amount to put into high-risk investing, if any. It optimizes both the standard and the high-risk goals to minimize risk and maximize the goals. It also ensures that the investor does not put their critical needs in jeopardy. This should relieve the stress on the client, as well as the stress on the client-advisor relationship, should problems occur. It also encourages the client to participate in the high-risk investments, especially if they have some particular expertise that can be useful. By reducing the client stress and allowing them to take on some responsibility if possible, the plan improves the likelihood that the relationship between the client and the advisor will be strong even in periods of poor market returns. If you have any questions or comments, or if you want more information, please email us at info@guidewayfinancial.com, call us at 512-487-7762, or visit our website at www.guidewayfinancial.com.